Good evening, friends. Welcome to the web coaching sessions of Insurance Institute of India for licensure examination. The course IC01 Principles of Insurance covers 9 chapters, starting with risk management, concepts of insurance and evolution, the business of insurance, insurance market, insurance customers, insurance contract, terminology, life and general insurance products. We look at the first two today. Risk can be identified, measured, controlled and final. This is the fundamental principle of the discipline of risk management. The good starting point therefore would be to look at the meaning of the word risk. You all may be aware that the moment we talk of risk management, insurers are the first to be concerned. Why so? We will appreciate that huge amounts of liabilities are assumed by insurers through various types of products sold by them. They come across various complex situations in underwriting. Losses come to them in various shapes and sizes. And last but not the least, most importantly, immediately after the insured, they are the ones who monetarily suffer in the event of a loss. Look at this. A network of flyovers. When the insurance company issues a policy, there is nothing on the ground. There is something after the completion we see this type of pictures, and they have to decide what risk they are taking up. High-rise buildings, the fires in high-rise buildings, cities on fire, complicated petrochemical plants, refineries, offshore installations, marine cargo, marine hull, perils of nature like earthquake, storms, floods, and the devastating damages caused by them. This is tsunami picture. What does insurance do? Insurance does not and cannot protect an asset. Equally, it cannot prevent any accident from occurring. It only reduces financial impact of an accident. It provides compensation for monetary loss. Underline the word monetary. Risk is defined in different dictionaries as, let us look at the Oxford Dictionary. It says risk means hazard, chance of bad consequences, loss, etc., or exposure to mischance. Chambers Dictionary says risk is hazard, danger, chance of loss or injury, degree of probability of loss. What we are more used to in insurance parlance is the person, thing or factor likely to cause loss or damage. The old days the word used was danger. Both life and property are exposed to loss or damage due to accidental circumstances for an individual, business, commerce and industry. All these accidental happenings which produce a monetary loss are termed as risk. So, risk is something or some event that can cause harm or loss. It is the exposure to events which cannot be predicted with absolute certainty. To understand severity of a risk is often analyzed for probability, that is chance of occurrence. Higher the chance that it will happen, higher the risk. Mind you, risk is not always loss causing, and some risk may cause both loss and gain. Usually to different people, as with the extra work a repairer gets after a storm or flood for repairs of houses, other damaged goods. Let us now look at the difference between risk and uncertainty. Risk are those for which the probability of occurrence can be calculated, projected, forecasted either on a rational basis or on the basis of available statistical analysis of a number of similar events that have occurred in the past. That means Based on the previous trend of what happened in the past, we are trying to make some forecast for the future. Whereas uncertainty is something for which analysis is impossible by virtue of the fact that they are either a one-off event or because their occurrence does not follow an apparent pattern of events. There is no consistency. The word one-off shows that it happens once in a while. Now the word risk, when we use the word risk, we have to be careful as to what we mean by that. Insurers use this word to indicate the subject matter of insurance. For example, when they send an engineer for doing inspection of a particular facility, they say the engineer has gone for a risk inspection. Equally, when they cover fire insurance, the perils of fire, they say we are covering the risk of fire, flood, and the like. Let us quickly look at what these definitions relate to. What are we concerned with? Uncertainty indicates may or may not happen. Hazard indicates the condition that increases the chance of loss, physical or moral. When we say physical loss, that is the loss of assets which can be seen measured. Moral relates to character. We will see that in little more detail subsequently. Probability is a chance of occurrence. Higher the probability, higher the degree of risk. Perils are causes of loss. Fire, flood, riot, burglary, whatever. This can be a very big list. An event or incident that may cause a loss, or in very simple terms, a cause of loss itself is a peril. We can broadly divide these perils into two categories, mainly natural perils and man-made perils. Here is the indicative list of natural perils and man-made perils. Earthquake, landslide, rock slide, subsidence, flood, inundation, glacier breaks, storm, tempest, cyclone, hurricane, tornado, tsunami, cloudburst, volcanic eruptions, avalanche, hailstorms. And what surprises of the nature we haven't seen yet, it is always important to qualify by saying that other disturbances of nature. You may recall that the word tsunami was not known to many of us until that Asian tsunami in 2004. It was only after that the word tsunami became a word of common use in the insurance parlance. The man-made perils relate to terrorist attacks, terrorist strikes, cyber attacks, simple malfunction of any machine or any device, financial aspects, legal aspects. They do provide, create certain risk. And as we develop in economy, technology, new types of risks do come in, like hijacking, use of hazardous materials, pollution caused by the use of materials, electronic data processing, and these legal and political areas. And mind you, this is a very, very dynamic area where the risks keep on getting added to the existing list. How do you classify? Let us look at risk classifications. The basic is personal, property or liability risk. Personal relates to potential loss to the persons. Property relates to potential loss to property. And the liability relates to potential liability for an individual or for an institution and organization. Here the word liability, we are talking of legal liability that these entities may face. Another way of classifying is physical, social or market risk. Physical, like the natural perils or even people call them as acts of God perils. These are storm, tempest, flood, hurricane, tornadoes, cyclones, and any other natural phenomena. Social risks relate to riot, strikes, civil commotion, burglary, theft, and the like. The market risk relate to the price reduction or the purchase and sale constraints are involved. See, somebody makes a projection that he will be able to sell his product at say 100 rupees a piece, and with changes in the market, he is unable to sell it for more than 50 rupees. Another way is pure and speculative risk. When you say pure, there is only chance of loss and there is no chance of gain at all. Whereas speculative risk relates to chance of gain as well as chance of loss. Like say you are investing in the share market. Another style of classifying is static or dynamic. Static is losses caused by natural perils or mistakes and misdeeds of human beings. The frauds will come in this category. Dynamic risks which are associated with changes in economy, human wants, and improvements in machinery or technological innovations. When we say changes in human wants, change of fashion, change of style, change of taste, all these things will come in this category. Yet another way is fundamental or particular risk. Risks which are associated with groups, which are impersonal in original and effect. These are fundamental risks, are in the form of political or economic changes happening to a group. That means they affect a group of people or the whole society as a whole. Whereas the particular risks are associated with individuals. Financial and non-financial risks. Losses caused by such risk are measurable in monetary terms, that is financial risk, which are not measurable in monetary terms are non-financial risks. Just a summary of what we discussed so far. Catastrophic risk. Single event leads to higher than usual number or amount of claims. Financial risk relate to loss quantifiable in monetary terms. Non-financial loss not quantifiable in monetary terms. Dynamic relates to changes in economy. Static relates to natural perils or misdeeds of human beings. Pure risks are something which is beyond the control. There is only chance of loss and no gains. Speculative relates to both chances of gain or loss. Fundamental risks affect a group of people. For example, political risk, economic risk. Particular risks are associated with individuals. How do you manage these risks? Fundamentally, there are identified 4 steps. When you say you have to manage a risk, means you have to first understand it. That means identify it. The different words used for the identification are recognition, anticipation. This process is the most important process in the whole game of risk management. Unless you identify your risk, you can't manage them. There are a variety of ways and methods by which risk can be identified. Somebody can do it by way of a physical visit to a particular facility. You can identify the risk by getting different types of information through proposal forms, questionnaires, and written documents. Equally, you can get to know about things from websites and different other sources where the information is available in public domain. Having identified or anticipated certain risks, we have to now look at what will be the impact of these risks. And what we are concerned is the monetary impact. How frequently can it happen? What will be the severity if it happens? So here we are concerned with estimating the likely probability and likely severity. You must have heard the word probable maximum loss. Many people also call it maximum probable loss. This terminology is a part of the risk evaluation or assessment process. This process is also called risk measurement. The insurers, reinsurers use this terminology PML in deciding how much they want to retain on their own shoulders and how much they want to pass on to somebody else like a reinsurer. The next step in this process is prevention and control. These relate to measures to avoid occurrence of a risk, which is not always possible. If you cannot avoid a risk, can you limit its severity? Can you limit its impact and reduce its consequences? This whole process is called prevention and control. Monitoring of what you do here is an extremely important step. Financing of risk. Determining what the cost of risk is likely to be or might be, and ensuring that adequate financial resources are available. If we talk with somebody taking insurance and cost of risk, the premium which is paid for protection of the risk goes as a cost of risk. Losses which are not insured, risks which are not insured by the traditional insurance products are again ones which are going to the cost of risk. Uninsured losses, premiums paid, the investments made for improving risk on loss or incurring expenditure incurred to install risk management or loss prevention measures. All these things will come into this. It may also happen that many times the clients who are financially very big may decide to take insurance at a particular level. That means they will decide to have a little higher deductible than which is practiced generally in the market. They are trying to retain a larger chunk of the loss on their own shoulder. All these issues come in the area of risk financing. Just to give an example, how do you reduce risks? Either by separating, or by duplication, or by diversification. How do you do this? What you see on your screen on the left side are the 4 lots of materials stored at one place. Though they are 4 separate things, they are put together and become a separate, individually exposed group of risks. If at all a fire or a natural peril has to attack, all these 4 sections are vulnerable to a total loss. How do I do this? The separation technique is spread them out away from each other so that a fire starting in one section does not communicate or spread to the other section, because there is a sufficient distance kept between each of these lots. So you are isolating subjects exposed to the same risks. Duplication. We are all familiar with duplication or backup of data on computers and all electronic data processing. Duplication can also relate to manufacturing facilities. Diversifying or diversification relates to spreading of risk across different areas. All assets, all facilities are not concentrated in a single place. Let us look at this interrelationship of risk analysis, control and financing. Though these are small print, I will read it for you. It starts on the top left with the question, is there a risk? See, now again the risk is there or not, this perception will change or vary from individuals to individuals. If I feel there is no risk, I ignore it. But if there is a risk, that is my perception, the next question is, on the right side top is, has it been measured? If not, measure it. On measuring it, what is your idea about it? Is it significant? If you feel that it is not significant, when I use the word significant, when means, is it tolerable for you? Can you take it on your balance sheet or your own finances sufficient to take care of that risk, and you don't need any other support? But if it is significant, can it be avoided or eliminated? If it can be avoided or eliminated, do that. If it cannot be, then the question is, can it be reduced? Remember one thing here, when somebody says you reduce means out of 100% thing, you are reducing it to say 70% level. That means 70% is residual, 30% is removed. So there will always be something left as a residue. If it can be reduced, yes, definitely reduce it. Now, from here, the questions go in two limbs. If it cannot be reduced, the question is it catastrophic? Catastrophic means, can it cause a very big loss, big impact, big monetary impact? If it answer is no, then the next question to your mind is, can it be retained by you for your own account? If yes, do it. If no, you have to transfer it to somebody, and that one of the entities in that somebody is insurers. This is one side of the story. Other side, when we say it can be reduced, then reduce it, and then look at what is remaining, what is the residue. Is the residual risk significant? If it is yes, again you come to the same process of, can it be retained? If it cannot be, transfer it. Now, transfer by way of insurance is not the end of the story of risk management. In practical life, you will come across a large number of contracts, agreements, covenants entered into by different entities, in which there are responsibilities of different parties specified, and those to give you the risk areas. The contracts normally will talk of insurance, indemnity and liabilities. This will really tell you what are the risks which are there for insurance. When we say transfer risk by way of other than insurance, there can be indemnity agreements whereby one party agrees to compensate other for losses the other may suffer or incur. Hedging, you are doing some different financial transaction to offset loss in other transaction. See, there can be a variety of ways. These are just two indicative things.